Hi, and welcome to Financial Thought Exchange from the CFA Institute Research Foundation. I'm Larry Siegel, your host today, and my guest is Elroy Dimson, a professor of finance at Cambridge Judge Business School in Cambridge, England, and Fellow and member of the Investments Committee at Gonville and Keyes College at Cambridge. Elroy is best known as a co-author of the great book Triumph of the Optimists, which documents investment returns around the world from 1900 to the present. Maybe a little older now, maybe even earlier now. I'm not sure what has been done most recently, but we're about to find out. Elroy is the winner of a Verton Award from the CFA Institute Research Foundation and participated in our roundtable video, Rethinking the Equity Risk Premium. He's also an expert on endowment and foundation investment management and a distinguished financial historian. How are you doing today?
Oh, very good, and I'm looking forward to our conversation.
Oh, me too. I was reflecting on the fact that I started my career working with Roger Ibbotson on something called Stocks, Bonds, Bills, and Inflation back around 1979. And I hope this isn't actually true, but I may be ending my career doing the same thing. We're going to do a century edition in 2026, I guess. The data covered 1926 to the present. So when 2026 is the present, we'll do the century. Yeah, you have spent a good part of your life doing something similar, but not for the United States. Can you tell me how you got involved in that and just a little about it?
Well, I mean, my life story doesn't solely intertwine with Roger Ibbotson, but he played a significant part in my development, in some cases unknown to him. So
Like,
when I was searching for a dissertation topic at London Business School, I had received a copy of the proposal, not Roger's dissertation, just his proposal. And I thought that was such a smart idea that I thought if a PhD on IPOs in the United States is going to do so well, and at the University of Chicago, no less, how about me at London Business School? So long before I met Roger, he had actually had an influence on the direction that I went in, and my career was kind of path dependent. Each thing that I did opened up further opportunities. And I've kept in touch with Roger. I didn't know him at the time, though, and he was mapping out some of my future life.
well, I think I can say the same thing, but I never got the PhD and pursued a career more in business, although kind of on the academic side of business. What did you specifically do for your dissertation?
Well, the PhD was on IPOs, as I've just mentioned. The only data that people had back at the time when I was beginning my PhD was American data. And to do IPOs, what I did was I would get the tube, or as people in other countries would call it, the metro or the subway. I would go to the National Newspaper Library and I would get out old newspapers and copy out prices of IPOs.
Oh,
And so it started with that. And at the same time, we decided at London Business School that it was not good enough for there to be one authoritative source of stock prices. If Chicago could do it, London could do it. And so we started that as well. And these things came together. But my first involvement was IPOs. And that meant that I was trading in some very similar territory to Roger. And then I moved on to looking at long term returns because we'd created a database. And Roger migrated step by step from being a doctoral student to having responsibility for work in that area and using it. So was a great man who has continued to maintain those interests, and I've emulated it.
yeah. What did you specifically do with historical returns that had not been done before? Because for those of you out in the audience who don't know Elroy's work, A Triumph of the Optimists is a recounting of the growth of global equity markets not from their beginnings in the late Renaissance, but from, I think, about 1900
Yes, that's right.
to whatever time was then the present. And I first saw this book around the year 2000. So about a century of returns in what was really a turbulent period for Europe and Asia. Had two world wars and so forth, whereas the United States had a more or less continuous record. What did you do to get this fabulous data set?
To explain that, I think I've got to go back in history a little bit, explain a little bit about sort of how we compiled data for the UK, and then how that grew into Triumph of the Optimists, a data collector, which I'd worked on with two London Business School colleagues, Paul Marsh and Mike Staunton, to create something that was global. So we began with collecting data for the UK and had published work on that in the 1990s, going from 1955 to whatever the time was at which we were using the data. And so we had a data set there that enabled us to create indexes. And we did this both as academic work for refereed journals, but also out of interest. And the interest took us into creating an index for the UK called the FTSE Index, Financial Times Stock Exchange Index. Paul Marsh and I had done the research on that, and that became the index for Britain and still is. That was launched in the 1980s. By the end of the 1990s, the new millennium was coming, and it looked appropriate to take a more global perspective. That was the point at which we started collecting information from other countries. And we already had the American data. There were one or two other countries where there were limited data sets. But through the meetings that academics have, the European Finance Association meetings, which I went to a great deal, American finance less frequently, I got to write to people that went to these academic meetings, say, have you got data for your country? And we gradually accumulated data, including the US and the UK, for 10 countries at New Year 2000. And then, as we presented our first research results in different places, there would sometimes be somebody in the room who put their hand up and say, I've collected data for my country as well. Would you be interested in it? And so we ended up with a large body of evidence drawing in part on our own work, but very significantly on work that others had undertaken. So, Triumph of the Optimists was a book published at the beginning of the 21st century, which plotted the long-term record, not just of the US and the UK, but a very large number of countries. That number of countries has over the years expanded, and now we've got long-term data on 35 countries, looking at stocks, bonds, bills, inflation in terms of their long-term performance. This is not a minute by minute or day by day, but it's a year by year record covering a large number of markets.
So the title, Triumph of the Optimists, is provocative. It implies that there's a war going on somewhere between optimists and pessimists, and that you've presented evidence that the optimists have won. Who's on the other side, and what are you talking about?
Well, I don't know whether it was a war, but there were many people who were kind of cautious, and in many markets in the world, very cautious about risky investments. And so our take on it was that back at the beginning of 1900, there were optimists about the likely performance of industrial and commercial companies, which represented a small proportion of the stock market by value.
Yeah.
Or alternatively,
Railroads and banks, was it?
it was heavily railroads and banks in those two countries, yeah. And those optimists who saw that, but also saw that the stock market would evolve into covering many, many other sorts of businesses, that offered a future, a financial future. And so those people triumphed, and they did far better than the cautious individuals that kept their money in government bonds or in treasury bills or in cash. It was a remarkable 20th century.
One layer down, there are optimists and pessimists about the future of the economy and, frankly, the future of humanity. And there's a lot of talk going around now about all this. We're going to go extinct if we do thus and such, and then there's talk on the other side of limitless growth in human potential and economic possibilities. So, do you also believe that you found evidence for triumph of the optimists in that question?
Well, the optimists that did well, if you dig down in different markets, were quite often those who were willing to see that there were some prospects of recovery for what looked like doomed industries. So I'm not suggesting that candle makers and horseless carriage makers had a resumption of profitability for their businesses, but although there were businesses that disappeared, there were also cases where there were surprises. So, um, uh, railroads in my country put canals out of business, and people might have been focused on that. So, you might have thought, therefore, that trucking would put railroads out of business, and that flying would put land transport out of business. But surprisingly, some of these businesses which may have been confronting setbacks also did well. They're what we call value investments. They're ones where there's something of a setback. People think the price should be lower, and that means that when prices are lower, expected returns are higher. And so we find that phenomenon within markets and across markets. Distressed countries over the long run have given better performance than strong markets. The key exception is the United States. And so a disproportionate number of the people who listen to this will be saying, what about the US? The US has done very well. Things look less rosy at present, and people are asking themselves, will the wonderful performance of the United States over the century that went behind us, over the first quarter of the 21st century, will that continue or not? And jury's out.
It can't really continue at the same rate. The U.S. went from basically an advanced emerging market in 1900 or 1926. It was to indisputably a developed market by 1950, and then has been a developed market ever since. It's not that we haven't had our crises. The mid 1970s in the United States saw the lowest stock prices since the 1920s.
You're right, we can't have history repeating itself. In many cases, history does sometimes rhyme, but in this particular case, the United States began in 1900 representing 15% of global equities, and now it entered this year at just almost two-thirds of global equities. So if you quadruple your share of the global equity market and you end up with well over 60%, you can't do that again.
Yeah.
So that's that's simply not possible. Um, but
Not as a ratio. It is
yeah,
very unlikely, but it is conceptually possible that the U.S. could grow as much in the next 100 years as it did in the last 100 years. I just don't think it's going to happen because it's just hard to, when you're already rich, it's hard to get that much richer.
yeah, but there's also the question of what those competing countries do. So, what will be a successful or an unsuccessful outcome for the United States involves comparing the US with the other big market, which, if we incorporate all of its securities, including those that are held by the state and by families, is clearly China.
Yeah.
And so we will form a view as to whether the US has done well or not by looking at whether China turns out to have the rosy experience that the US had, or whether it's more like Argentina, which was once thought of as being one of the premier markets of the world, and went more or less nowhere. And you say that you can't visualize setbacks, thinking about the post 1950 period in the US. You are glossing over the fact, Larry, that there was a period where the biggest stock market in the world by value was Japan.
I'm saying that I don't care so much whether somebody else is winning a horse race somewhere else. I want my horse to not win. This isn't a race. I want my horse to go fast and produce something valuable. And if Japan was ahead of the United States in stock market capitalization in 1989, good for them. It didn't hurt us in any way. The U.S. was also at its own all-time high in 1989. Then what happened is the U.S. kept going up and Japan started going down. So that's a serious problem because we want.
The US should not have done so well. I mean, it really is a puzzle. If you've got such a well-governed market and such creative people and such a focus on business, then when we identified in Triumph of the Optimists that the 20th century had been good, it was not just a good 100 years, it was very good for the United States. And we did not expect the US to do well year after year after year for the first 25 years of the 21st century. But it happened. And there is some ground, I think, for having optimism about the creative processes in the United States and the entrepreneurship of the country. So I'm perfectly happy for my investments to be US heavy.
No, I am only happy in the sense that it's done good things for me, but I'm supposed to think about what's going to happen in the future. That's what my portfolio should reflect today, not what I did achieve, but what I hope is going to happen. I feel like we've hit a rough patch, and stocks are still very expensive, having fallen 10% or so, and we've recovered from these time after time and moved on to new highs, and almost feels like we've got some special dust in the air that allows us to do that. But I don't think the magic dust exists. And it's possible that your international portfolio is going to beat the U.S. Portfolio for quite some time. Is that something you've taken into consideration?
Well, in the early stages after we launched Triumph of the Optimists, there was this belief that emerging markets were going to get bigger and bigger, and people looked at population sizes and economic growth and so forth. So the BRICS story, the large emerging markets being future winners, is one that people believed in, and they were wrong. And the
I know. If you look at my portfolio, you'll see just how wrong.
yeah.
'Cause I certainly did believe that, and I actually continue to think that there can't the United States can't really become any more dominant in the world economy than it is without really annoying some powerful people in other places. So I would be betting on them again. I don't know about every single country in that group, but if you just take a cap weighted portfolio of them, it looks better to me than the United States does. Given current price levels.
Another explanation for the relative performance of the US versus the rest of the world over that very long period is what you're referring to earlier, the fact that the world wars afflicted Europe. So Europe suffered in a different sort of way from resource-rich and geographically distant countries like North America, like Australia, and so forth. So those were countries which lost a lot of their young men in the fighting, but they didn't lose their wealth.
No, they
So
But nobody suffered more than Japan. That they were in the only nuclear war that's ever happened as the loser, and yet from 1945 to 1989, Japan was by far the best performing market in the world, and that is an amazing story.
the other astonishing story was Germany's recovery, aided by the United States. But of course, if you'd gone into a meeting with clients, I guess it wouldn't have been institutional clients, but it might have been a family saying, I'd like to put a quarter of our net worth into Germany. It's 1946, 47 now. The war's behind us. Things look good. You wouldn't have got to coffee time. You'd have,
Oh gosh.
you'd have felt absolutely crazy. You would have looked very similar to anyone that might have suggested the same for Zimbabwe. The highest inflation rate that there's been is not the famous German inflation rate. In modern times, it was Zimbabwe, but that was a
I
wonderful
have
profit opportunity, as people know when you're being crazy.
I had 100 trillion Zimbabwean dollar note stashed away somewhere, but since it's completely worthless, I'm not sure I can find it. But if you walked into a client meeting and said, I want to invest, let's say, what was the market cap? Wait, 2%, 3% in Germany? You might have come out of the meeting alive and you would have made a huge amount of money for your client. Don't good investors look for screaming bargains, knowing that they could, if they're wrong, they're going to lose that little bit of their money, but they're diversified and should be able to do this in more than one part of the world?
Well, I think you're kind of right for certain categories of investors. If we think about what you or I could consume, it might be that after a point, we don't want any more money for holidays or for home extensions or whatever. And so you might say, well, I don't know what I'll do with it if I become seriously wealthy, but I could get some pleasure out of giving it away. So you might be willing to take a risk on losing some of your wealth in exchange for a small probability of doing well later on. But that story would work much better for a family office and much less well for an investor that's under public scrutiny, a pension fund, or even in many cases, a sovereign fund.
You brought up the topic of various classes of asset owners, on which you've done a lot of very useful work. And I'd like to turn next to that after the break, talk about sovereign wealth funds, endowments, foundations, family offices, and kind of how your work fits into the management of those types of institutions. So we've been conversing with Elroy Dimson, professor at Cambridge Judge Business School, and we're going to come back and do some more. Thank you for watching the Financial Thought Exchange, and thank you, Elroy.
For more information, please visit rpc.cfainstitute.org/research-foundation.